Meet Harry. He's a 35-year-old teacher making $65,000 a year. But in 30 years, he'll be earning more from dividends than his full-time salary. And he's doing it with just one ETF, no stock picking, no timing the market, just $500 a month on autopilot. The lazy strategy that's quietly building millionaire retirements? Let me show you. Hey everyone! Today I'm breaking down the ultimate lazy dividend investor strategy that's creating millionaires while they sleep. I'll show you 3 different single ETF approaches. One for safety-focused investors, one for balanced growth seekers, and one for maximum income hunters. Each strategy uses just one ETF, but they're designed for different investor personalities and goals. Whether you prioritize capital preservation, balanced growth, or maximum current income, there's a strategy here for you. By the end of this video, you'll know exactly which fund fits your goals, how much you need to invest monthly, and the shocking truth about which strategy could make you the most money long-term. This video is for informational and educational purposes only. It is not financial advice. All projections shown are based on historical average returns and past performance. These numbers may vary significantly based on market conditions, actual purchase prices, and timing. Past performance does not guarantee future results. But first, let's talk about why most dividend investing strategies fail. Here's the brutal truth. Most people overcomplicate dividend income investing. They chase high yields, buy individual stocks they don't understand, and constantly worry about their portfolio. Harry used to be one of these investors. He owned 47 different dividend stocks, spent hours researching quarterly reports, and still couldn't sleep at night wondering if his picks would cut their dividends. Sound familiar? That's when Harry discovered something game-changing. What if you could build serious wealth building with just one fund? What if financial planning could be as simple as one monthly investment? The answer lies in understanding which type of dividend ETF matches your personality and goals. The Quality Dividend Workhorse. Let me introduce you to the first contender, but I won't reveal its name just yet. This fund focuses on companies that have paid dividends for at least 10 consecutive years. We're talking about the cream of the crop. Businesses so stable, they've weathered multiple recessions while still paying shareholders. This powerhouse manages $69.32 billion in assets with an incredibly low 0.06% expense ratio. But here's what caught my attention. It's yielding 3.87% annually with quarterly payouts that have grown over 160% in the past decade. Smart money is paying attention. This fund has 1,832 institutional owners holding over 900 million shares. Major players like Kingstone Capital Partners, LPL Financial, Raymond James, and Morgan Stanley are loading up. The fund attracted $13.19 billion in inflows over the past year alone. That's serious institutional confidence. The top holdings? Energy giants like Chevron and ConocoPhillips, tech stalwarts like Cisco, and consumer staples like PepsiCo. These aren't flashy growth companies. They're money management machines that prioritize returning cash to shareholders. Harry's portfolio was transformed when he discovered this approach. Instead of chasing the latest dividend darling, he found a fund that does the heavy lifting for him. The Broad Market Income Generator. Next up, we have the ultimate diversification play. This fund doesn't just focus on dividend aristocrats. It captures the entire large-cap U.S. market, including companies that might surprise you with their dividend growth potential. With a massive $1.5 trillion in assets under management and an expense ratio of just 0.03%, this is efficiency at its finest. The dividend yield might seem modest at 1.21%, but here's the kicker. The underlying companies have grown their dividends by 7.79% annually over the past 3 years. Institution domination. This fund has 3,518 institutional owners holding over 459 million shares, with Vanguard Group itself as a major shareholder. In July 2025 alone, it attracted $12 billion in new capital and is on pace to exceed its 2024 record of $116 billion in inflows. When the smart money moves this aggressively, you pay attention. Think about it. While the current yield is lower, The compound interest effect of consistent dividend growth could potentially outpace higher-yielding alternatives over decades. The top holdings include Nvidia, Microsoft, Apple, Amazon, and Meta, companies that are increasingly becoming dividend growth stories, not just capital appreciation plays. The enhanced income specialist. Now for our final contender, the one that income seekers absolutely love. This actively managed fund takes a completely different approach, using covered calls to boost income beyond what traditional dividend investing can deliver. With $4.74 billion in assets and monthly distributions yielding 4.64%, this fund aims to generate income two ways: traditional dividends and option premiums. The monthly payout frequency is a game changer for anyone wanting consistent cash flow. Growing institutional interest. Despite being actively managed, this fund has attracted 293 institutional owners, holding over 58 million shares. Major holders include Raymond James Financial, LPL Financial, and Wealth Enhancement Advisory Services. The fund pulled in $1.08 billion in net inflows over the past year. Impressive for a specialized strategy. But here's the twist. This strategy comes with a trade-off. By selling covered calls, the fund caps some upside potential in exchange for that enhanced yield. It's designed for investors who prioritize current income over maximum capital appreciation. The concentrated portfolio of just 27 holdings includes quality names like Meta, Microsoft, and Caterpillar, but with an options overlay that could potentially provide smoother returns during volatile markets. Speaking of which, let me reveal these three powerhouses. The quality dividend workhorse? That's SCHD. The Schwab U.S. Dividend Equity ETF. The broad market generator? VOO. The Vanguard S&P 500 ETF. And the enhanced income specialist? DIVO. The Amplify CWP Enhanced Dividend Income ETF. Now, here's where it gets interesting. Let's see what happens when Harry commits $500 monthly to each strategy. How we calculate these numbers. I'm using historical average annual returns. SCHD at 7.43%, 3-year average. VOO at 16.55%, 3-year average. And DIVO at 11.84%, 3-year average. For dividend calculations, I'm using current yields. SCHD 3.87%, VOO 1.21%, and DIVO 4.64%. I assume 3% annual dividend growth for all strategies and quarterly compounding for contributions and reinvestment. Remember, these projections are based on past performance and may vary significantly in real markets. If you're finding value in this breakdown, smash that like button. It helps more people discover these financial independence strategies. Strategy 1. The SCHD Safety First Builder. $500 Shark Month. Let's follow Harry's journey with SCHD, perfect for investors who prioritize stability and consistent dividend growth over maximum returns. 10 years in, Harry's put in $60,000 of his own money, but his SCHD portfolio has grown to $78,742. His annual dividend income? Over $3,000. That's $254 hitting his account every single month. Harry's literally covering his car payment and insurance with dividend checks. 20 years in, Harry's dividend income alone is nearly $8,000 annually. $7,796 to be exact. His $120,000 in contributions has grown to over $200,000. Now for the jaw-dropping finale. After 30 years, Harry reaches retirement at 65. He invested a total of $180,000 over 3 decades. His portfolio? $441,234. But here's the kicker. He's now receiving over $17,000 annually in retirement income. That's $1,422 every single month in passive income that could potentially grow every year. Strategy 2. The VOO Growth Machine. $500 SAA month. But what if Harry chose the broad market approach with VOO instead? Ideal for younger investors focused on maximum wealth building. 10 years in, Harry's $60,000 becomes $89,341. 20 years? his 120,000 contributions explode to $267,892. The dividend income is growing too, over $3,000 annually by year 20. Here's where VOO shows its true power. After 30 years, Harry's portfolio reaches $683,245. That's nearly double SCHD's final value. His annual dividend income? $8,267. The total portfolio value is significantly higher than SCHD, but current dividend income is lower. This is perfect for someone who wants maximum wealth accumulation. Strategy 3. The DIVO Income Maximizer. $500 per month. Finally, let's see what happens with DIVO's enhanced income approach. Perfect for investors who need higher current income right now. 10 years in, DIVO is pumping out $3,474 annually in dividend income. That's nearly $300 monthly in cash flow. By year 20, Harry's collecting over $8,600 annually, $8,618 to be precise. His portfolio value? $185,734. The grand finale? After 30 years, Harry's generating nearly $17,000 annually in income, $16,909. That's almost matching SCHD's dividend output, but with a lower total portfolio value of $364,425. Here's the fascinating part. Each strategy serves a completely different goal. So which strategy wins? It depends on your goal. VOO builds the largest portfolio, $683,245 after 30 years. Perfect for long-term growth. DIVO delivers the most income early, with monthly cash flow and a 4.64% yield. SCHD balances both reliable dividend growth, strong fundamentals, and defensive traits that help you sleep at night. But here's what most investors miss. You don't need to pick just one forever. Harry started with DIVO in his 30s for monthly income, shifted to VOO in his 40s for growth, and moved to SCHD in his 50s for retirement stability. That's the beauty of this strategy. Each ETF is liquid, diversified, and professionally managed. No stock picking, no stress. Just one fund and one goal: freedom. With $500 a month and 30 years of patience, you could build a portfolio producing $8,267 to $17,072 annually in passive income. Harry isn't watching stock prices anymore. He's focused on life, while his money works quietly in the background. Which strategy fits your goals? Comment below. Subscribe and join the lazy investor movement.